Warren Buffett's best advice for investing. Lessons from the Oracle of Omaha. Lessons from the Oracle of Omaha delves into the invaluable investment wisdom shared by Warren Buffett, widely regarded as one of the most successful investors of all time.
When I was 11, I picked stocks. I had the whole wrong idea.
Here are some key lessons and advice that can be explored. Long-term value investing. Long-term value investing is at the core of Warren Buffett's approach. He emphasizes the importance of looking beyond short-term market fluctuations and focusing on investing in solid companies with strong fundamentals and durable competitive advantages. This philosophy allows investors to capitalize on the long-term value and potential growth of businesses.
You need the right orientation.
This patient and disciplined approach has been key to his consistent and successful investment track record. Invest in what you understand. Warren Buffett advocates for investing in what you understand. He emphasizes the importance of thorough research and deep understanding of a company's business model, industry dynamics, and competitive advantages before making investment decisions. By investing in industries and companies he comprehends, Buffett minimizes risks and maximizes his ability to make informed investment choices. Margin of safety. Warren Buffett's margin of safety concept entails purchasing assets at a substantial discount to their intrinsic value. This approach provides a buffer against potential risks and uncertainties, protecting investors from downside risk. By acquiring assets with a margin of safety, Buffett increases the potential for long-term gains as the market eventually recognizes their true value. Buy low, sell high. Warren Buffett's strategy of buying low and selling high is a key aspect of his investment approach. He seeks to acquire stocks when they are undervalued, offering attractive opportunities for long-term growth. Buffett avoids following the herd mentality and has the courage to go against market trends, capitalizing on favorable valuations and maximizing investment returns. Embrace market volatility. Warren Buffett embraces market volatility and sees it as an opportunity rather than a threat. He takes advantage of market downturns to acquire quality investments at attractive prices, capitalizing on the irrational behavior of the market. Buffett's long-term perspective allows him to navigate through volatility and generate substantial returns over time. Focus on quality companies. Warren Buffett prioritizes investing in quality companies that exhibit strong management teams, sustainable competitive advantages, and predictable cash flows. He focuses on businesses with long-term growth potential and a track record of consistent performance. By selecting quality companies, Buffett aims to minimize risk and maximize the potential for long-term returns. Ignore market noise. Warren Buffett has the ability to ignore short-term market noise and remain focused on the long-term prospects of his investments. He avoids market timing and speculation, understanding that short-term fluctuations often distract investors from their long-term goals. Buffett's disciplined approach emphasizes the importance of staying true to his investment principles and avoiding reactionary decision-making based on market noise. Learn from mistakes. Warren Buffett openly acknowledges his investment mistakes and emphasizes the value of learning from them. He has made notable blunders, such as the purchase of Berkshire Hathaway's textile business. Buffett learns from these experiences, adapting his investment approach and refining his strategies to avoid similar pitfalls in the future. Think like a business owner. Warren Buffett encourages investors to think like business owners when investing in stocks. He emphasizes the importance of evaluating companies based on their long-term prospects, competitive advantages, and sustainable business models. Buffett's approach involves analyzing businesses as if he were buying the entire company, prioritizing long-term value creation over short-term trading.